Well, hi there, Aaron Dunn here, and welcome to this week's edition of Feeling Smarter. As always, I'm joined by my co-host, Tim Miller. G'day, Tim. How are you?
Yeah, going pretty well, Aaron. How are you doing?
Not too bad, thank you. Well, as many people are still working through the annual compliance obligations of a number of their SMSF clients, we want to start to turn our attention to the fact that 30 June is very quickly approaching, and that therefore leads all roads towards SMSF tax planning. I think it's fair to say, Tim, that tax planning at 30 June 2026 is starting to look a little bit different to what we've seen in previous years. What are some of your initial thoughts from the conversation that we had, I guess, before this around some of the things that might look different as we lead towards the end of this financial year?
Yeah, well, it's one of those, where do you start kind of scenarios. I mean, there's the obvious one, and that is the introduction of Division 296 will obviously have a bit to play in, and we've spoken about this before, but that's going to be relevant for every fund. Not just the funds that we absolutely know will be impacted by Div 296, but everyone's got some decisions to make in the 26-27 year, and some of that will require some pre-30 June 26 action around capital gains. So there's that. That's one thing. We've obviously got the introduction of payday super. So there's a bit of a realignment of when super guarantee contributions will be made moving into the new year. So how does that change certain strategies? And how does it impact things like salary sacrifice? And of course, salary sacrifice becomes relevant because you and I like to talk about things like TRIS and TRIS strategies, and with the reduction of the lower tax bracket through the stage 3 tax cuts. So there's just this myriad of things that we've got to look at in addition to our standard. What are the contribution caps going to be like next year, and should we be contemplating reserving contributions in June? So there's our standard stuff that you and I like to talk about, adding on top of that all these new changes that are coming in as well.
Yeah, so maybe let's sort of drill down a little bit on the contribution stuff, because you've already highlighted the fact that we ordinarily, take advantage of our caps, but we do note that we are seeing contribution cap changes from the 1st of July. And so that naturally presents some opportunities for people to think about the timing of when they're going to be making contributions. And we also have, as you rightly mentioned as well, the introduction of payday super, and that's going to change the timing of receipt of payments, obviously aligning to salary and wages as well. So contributions, first and foremost, I guess, through these standard indexation calculations and stuff we see are certainly something that will be front and center in the lead up to 30 June this year.
Oh, absolutely. And, with the standard cap, so not even contemplating the any carry forward amounts people have, the standard cap being the $30,000 this year, that's obviously for most people the first target of where they sit in relation to that cap and its operation. And of course, with that, then they have to then start to think through, whether there is an opportunity for catch-up contributions. But leading into all of that, they have to understand what their timing and notice lodgement requirements are as well, because if they are looking to make personal deductible contributions, and the contributions must be in by the 30th of June. I don't know what day the 30th of June is this year. Sure, we've had a few weekends. So I'm pretty sure it must be a weekday this year. But getting your notice in on time from a requirement point of view. But the other side of that, Aaron, is the time is now ticking. If people haven't looked at contribution splitting from last year's contributions, they've got to make sure they get any splitting application in before the 30th of June as well. So, these are all the things that we've got to factor in when it comes to contributions, not just the caps, but, any elections required to do with any contribution strategies around splitting, deductible contributions, reserving, other things like that as well.
Yeah, and I think just sort of finishing off the topic of contributions here, whilst we might be taking advantage of the sliding tax scales that we have for I guess bringing someone down to particular thresholds, this year is really going to be the final year in many instances where fairly low rates, so above the tax-free threshold, are going to provide a greater level of deduction than what we would see as assessable inside the superannuation fund, because 1 July 2026, as we know, we see that tax rate change for those amounts above the tax-free threshold dropping from 16% to 15%, and then from 1 July 2027, seeing that drop further down to 14%. So just because you might be taking advantage of these strategies right now doesn't mean that you're going to continue to, in essence, lock that in, and you're going to need to revisit that because of that marginal tax rate change we're going to see.
Yeah, that's right. That's right. And I know we're going to look at that again at a future point in regards to the whole TRIS strategy. But that's that whole piece of money inside versus outside of super. And of course, we see in a year's time the changes to the listo as well, to ensure that people having money in super are not actually worse off than having money outside of super.
Yeah, absolutely. Well, the other one you spoke to at the very beginning, of course, is around the Division 296 tax reforms. And reform seems to be the buzz item right now, not only in respect to Division 296, but quite clearly the government is going to have a lot to say come federal budget night, and in particular around CGT reform as well. So I think it's fair to say, Tim, that the way in which clients, not only individually, but if we focus on SMSFs, are going to need to give some consideration to the way in which they might be planning how assets are held within superannuation more broadly because of the impact of Division 296, but also maybe thinking even a little bit more inside the fund off the back of any potential CGT reform that comes into play too.
Yeah, and of course it's difficult to speculate pre-budget. I mean, obviously there's always leaks, and we've seen plenty of press around it, and seen press around potentially only impacting say assets moving forward. So that some certain grandfathering provisions. Again, we always get our tails up when we hear the word grandfathering and what that means inside the super industry. So there's a bit to contemplate there from a pure investment point of view, to see what comes about, particularly with regards to the idea of borrowing to invest inside property inside a superannuation fund, because then that's the other thing is with inflationary conversations going on around at the moment, how attractive does borrowing become from an SMSF point of view? So, like with all the things you and I often speak about, it's not just one particular matter that we've got to discuss, i.e. CGT. It's the flow on of the way you get there, like how are you acquiring that property? Are you acquiring it through borrowed monies or directly, and then meeting all the conditions from an investment restriction point of view? So, makes life pretty easy for SMSF trustees and members.
Yeah, well, you're talking about the borrowing, and I think in some of these videos historically, we were raising some concerns about the LRBA safe harbour and the fact that we were going to end up with an interest rate that was going to be much higher due to the fact that it's locked in May every year. But yet here we are probably likely to see that figure increase and then in essence lock in again for a further 12 months, further highlighting the fact that in this tax planning period, it is important that we're spending time understanding the different rates of interest and thresholds and other aspects of the law that all basically come in and hit this junction of what we call a client self-managed super fund.
Yeah, that's right. And, and I mean, it'd be remiss of me, Aaron, just because of a lot of the stuff that we've been doing over the last 18 months, it would be remiss to not mention that for those people out there with defined benefit pensions inside their self-managed super funds, what are they contemplating before Division 296 comes in, where they're under a different total super balance reporting regime to your standard account-based pensions or accumulation interests. So, we just have to add that to the tax planning agenda, and that is, have you actually really worked through the realities of any remaining legacy pensions?
Yeah. Well, we're going to talk about some of these topics in a little bit more detail in some of our upcoming Feeling Smarter sessions. We'll maybe delve into both pensions and contributions and other aspects in the lead up to our upcoming SMSF tax planning webinar, where, Tim, not only, I guess, do we talk about some of these topics, but we bring together our comprehensive SMSF tax planning checklist and guide that professionals can look to utilise within their practice as they go through and explore many of these issues with their SMSF clients.
Absolutely, which is just another reminder to me that I better get cracking on updating all those links.
Absolutely. Well, thank you once again.
Always a pleasure.
And we look forward to you joining us for next week's edition of Feeling Smarter. Take care and bye for now.
See you all.